Do you have too much in stocks? This is Bill Scheid from Applied Finance Research. That was the very question I asked myself when my family asked me to create a new investment system for them. My concern was that we had so much exposure to equities already, so I started thinking about alternative asset classes and what kind of results we can get by applying our monthly asset allocation systems. The question of whether you have too much in stocks is a good one, considering how volatile the stock market can be. As we see here, the S&P 500 has had a drawdown of minus 55.2% in the last 20 years of history. That's a pretty big drawdown. And even if you have a 60-40 diversified mix of stocks and bonds, your maximum drawdown is still minus 35%. Plus, as we can see here, even with that 60-40 diversified portfolio, you still have a correlation with the S&P 500 of 0.93. That's a very strong correlation, and it has to do with the fact that when the markets are in a panic, no matter how diversified you are, the correlations between various equities often approaches 1 because the herd all stampedes for the exits at once. So in terms of asset classes outside of equities, gold, bonds, and real estate are amongst some of the most popular with investors around the world. The total assets under management for the 3 largest ETFs in these categories is greater than 228 billion. Now, my prior belief was that gold is too volatile and that bonds and real estate don't offer high enough returns. That is, until I started questioning my own beliefs. So I asked myself, what kind of returns can we get if we add some alternative asset classes to our equities and we mix gold, bonds, and real estate with a little bit of equities and then apply systems thinking via our monthly asset allocation systems? I chose a very simple mechanical rule set that comes straight out of the courses we teach. It's so simple that the rules can be counted on one hand. Plus, it's based on academically researched market concepts that have been published in major financial publications for decades. And I had some very specific objectives for this system. To make it worth my while, I'd like to beat the return of the S&P 500. By how much? Well, we might as well go big and we'll say we want to beat the S&P by 100% or more. It sounds impossible, but let's go for it anyway. And what if we can beat the S&P while also having a lower drawdown than the 60-40 diversified buy and hold portfolio? 60-40 never beats the S&P in terms of total return over the long run, but the upside, of course, is that the 60-40 has much lower drawdown. So what if we can have our cake and eat it too? What if we can beat the S&P and have an even lower maximum drawdown than the 60-40 buy and hold? And because the main idea is to diversify away from equities, let's shoot for an S&P 500 correlation of 0.25 or less. Now, let's take a look at some results. Here are the results of backtesting the system that I created out of this brainstorm. This backtest covers the last 20 plus years and was generated by etfreplay.com. It does not include slippage and commissions, just for clarity. On the graph, the green line is the equity curve for the system, while the blue line is the equity curve for the S&P 500. We see here that the system returned 972%, while the S&P returned 734%. The volatility of the system, as measured by the annualized standard deviation of daily returns, the system came in at 11.6, while the S&P came in at 18.9. So we see here that the system had a greater return on lower drawdown. The maximum drawdown of the system was only 17.3%, as we see down here, versus the 55.2% for the S&P 500. That is a fantastic, very low maximum drawdown. And it turns out the system's correlation with the S&P 500 is only 0.25%. So let's compare those results to our objectives. So our first objective was to beat the S&P 500 by more than 100%. The S&P returned 734.8% for this period, while the system returned 972.8%, which means the system beat the S&P by we beat our goal, let's say, or we beat the S&P by 238%, which was ahead of our goal of beating it by 100%. I thought 100% was going to be pretty tricky, but it turns out the system had an excellent return. Our second objective was to have less of a maximum drawdown than the 60-40 portfolio. The 60-40 had a maximum drawdown of minus 35.4%, while the system had a maximum drawdown of minus 17.3%. So that means that the system had less than half the maximum drawdown of the 60-40 portfolio and way less than the maximum drawdown of the S&P 500, which came in at minus 55%. And our third objective was to have an S&P correlation of 0.25 or less, and the system came in right at 0.25. So as we can see here, if we have too much in stocks and we'd like to diversify away from equities, it's not too hard to create excellent results by applying systems thinking via our monthly asset allocation systems to these very popular asset classes outside of equities. If you would like more information on this system or any of the systems we teach, please visit us at appliedfinanceresearch.com and also find us on Patreon at Applied Finance Research. This is Bill Scheid from Applied Finance Research. Happy investing, and thanks for watching.